Hello guys and welcome to another video. My name is Mark, I'm an entrepreneur and property investor, and in today's video we're going to be talking about how I would get started in investing if I had £1,000. Now first of all I want to manage expectations. You're not buying a Ferrari or a Lamborghini off a £1,000 investment in my opinion. Maybe if you put the money in Bitcoin 10 years ago you would have been there. Today, without it being incredibly speculative, it's impossible for me to really call it anything other than a gamble if you're trying to sort of get those sort of returns. Instead, what we're going to concentrate on today is how you could use £1,000, start to form a habit and start to build a portfolio that's going to make sure that you are wealthy in the future. So I think what we'll do today is we'll go over to the computer, we'll get stuck into it. Please give this video a big like if you haven't already. It really helps me out with the algorithm. And if you've not already subscribed, consider subscribing. We give away the dividends up from our dividend portfolio every month. On top of that, we're hopefully going to be giving away an investment property in a year or so once we hit 100,000 subscribers. So Nick, let's head over to the computer, show people what I would do if I was starting again to get a habit formed and start building my wealth. Let's go. So here we are, guys. You join me over at the computer. Nick, could you come and get the screen recording? Is that all right, buddy? Yeah. And then we can get stuck into what I would do if I was starting again. So guys, here we are. You can hopefully see my screen at this point, and I'm just going to flick through a few things and explain exactly how I would start if I was starting again with only £1,000. So the first thing that I would do is understand that my options are very, very limited. So I could either start a business, which would be incredibly active. I don't really view that as investing. It's more about building. So I don't really want to talk about building a business. I've done other videos on that. What I want to do is sort of start talking about passive investing so that you can start building your wealth while you sleep. So when it comes to £1,000, you really are going to be limited to only a few asset classes. You could, of course, go high risk, high reward and look at cryptocurrencies, things like that. I'm not going to pretend I didn't do well out of cryptocurrencies back in the day, but today my holding in crypto is zero. I may well re-enter that market if it comes down a lot, but at the moment I'm not personally holding anything, and I'd find it hard to advise anybody to really take that gamble, because that's what crypto really is. It is a gamble, whereas there are lots of options that are pretty much guaranteeing you a result over time, such as investing in the stock market, investing in property. They have big track records that you can look at when looking into the future that can pretty much guarantee you a result. So today we're going to talk about those. In particular, we're going to talk about ISAs and we're going to talk about the stock market. And the reason is £1,000 is not going to buy you a property unless you are very, very fortunate and manage to convince somebody to give it to you for free or to do some other strategy that's going to allow you to get access to a property for a very small amount of money. For the majority of us, that's not going to be the case. We need to start building our capital reserves up. So today we're going to talk about ISAs, because in the UK, we have a very privileged position where we can invest into something known as an individual savings allowance. So for me, an ISA would be the very first place I would look if I was looking to build my wealth and I had only £1,000. Now, as you can see on my screen, every year at the moment, your ISA allowance is £20,000. That means you can invest £20,000 and any money that money makes over your lifetime is absolutely tax-free. It's an amazing tax-free giveaway. Now, if you did it in a cash ISA, let's have a quick look and see what we could get. Cash ISA rates. At the moment, we are looking at, let's just look at one of the big ones, okay? So what we'll do is we'll go to the Halifax ISA interest rates. And obviously there are other banks out there. I just know that I had a quick look earlier. And to prove a point, it's 0.2%. So for me, I couldn't possibly invest in a bank which is going to return 1.8% less than inflation at current rates. So that means you're losing money every month you put it into that bank account. That for me isn't a great investment. Instead, I would personally look at something like a stocks and shares ISA. And I think what we'll do is we'll have a look at the subscriber dividend portfolio so I can tell you exactly what I would invest in within that stocks and shares ISA. Now, there's three options. Number one, you can invest in bonds. Number two, you can invest in mutual funds. Number three, you can invest in index funds. Or number four, in fact, there's four options, you can invest in individual stocks or REITs. So I'll go through each of those in turn very, very briefly so that you can understand what they are, and then we'll have a look at some examples on the screen at the same time. Number one, bonds. Now, bonds are essentially just a fancy name for lending some money to a company or a government. It's as simple as that. It's a fixed return investment. So you could invest in a bond portfolio, which will give you a fixed return. Now, the value of the bonds go up and down depending on their relative value to the interest rates. So let's say, for example, we lent some money at 5% to a government, and now that government's able to lend at 3%. Well, the bond that we hold is worth more than the current bonds that are being issued. Does that make sense? Hopefully. Nice and simple. So bonds, very unexciting in my opinion, and fixed income is also known as. Number two, mutual funds. So mutual funds are where you have a fund manager who's aiming to beat the market performance by picking stocks. So a good example of that, I'll see if we've got one in our, we don't actually hold one in here, and there's a good reason for that. I don't massively believe in mutual funds. And the reason is, in the long run, mutual funds have been shown in 9 out of 10 instances to lag the index funds, which is what we're going to talk about in a minute. On top of that, they charge you much larger fees. So the fees can be between 1% and 2% per year, whereas with an index fund, you can get them as low as 0.5 or 0.05, sorry. Like not 0.5%, but like 0.05%. A very tiny amount because it's a passive fund. It doesn't require big teams of analysts. It doesn't require a fund manager to be paid. It's very, very, very automated. So index funds are where I like to put my money. Incidentally, if you want to know about index funds versus mutual funds, there's lots of books on the subject. I don't feel the need to go back through all that data, but if you read Unshakable by Tony Robbins, fantastic book, it will tell you all you need to know about index funds versus mutual funds and their performance. So for me, index funds are the ones to look at. Let's have a look at one of the ones we have on our subscriber portfolio. And we'll go for the US index, and I'm expecting to see in the index, we're expecting to see things like Apple, Microsoft, Tesla, all the biggest companies in America. And what the index fund does is it tracks identically the index's performance. So as companies become more successful, the fund will automatically buy more of those stock. As stocks become worth less, i.e. the companies underperform, the index fund will automatically sell them so that the weighting stays the same relative to the index. That means you benefit from the overperformance of certain stocks and you get to get rid of the bad ones. I think that's probably why index funds tend to outperform mutual funds, because they're reflecting market reality rather than reflecting a hedge fund manager's or a fund manager's perspective of reality. So that tends to be, so if we look on here, we've got Apple, Microsoft, Amazon, Facebook, Alphabet is Google, as you can see, and it's all weighted as per the index would be weighted in reality in terms of the stock's market cap. That's essentially what an index fund is. It is an absolute representation of the index that you're buying. So for me, that's where I like to put my money. Now, what sort of returns can you expect? Let's have a look. So the S&P 500 has returned between 30 and 8.56% over the past 5 years, I think this is. But on average, if you took an average return over a 10, 20, 30 year period, it's often said that it's between 10 and 11% average return. So we can kind of plug those figures in and we can kind of work out exactly what that would mean for us if we were to achieve just the average return. So on £1,000 over a 45-year period, looking at this compound interest calculator, we would return somewhere in the region of £88,000. That's a huge return on investment. And what I really think people should get involved in at a very early age is just playing around with these compound interest calculators and working out if they invested a certain amount of money. Because the £1,000 is never going to make you rich, but forming a habit will. If you could say to yourself, look, I'm going to put in £500 a month, and I appreciate, I've done other videos on how to earn an extra £500 a month. I appreciate that's a big ask, but if you were to invest £500 a month, and you start with £1,000, well, in 5 years, you've got £40,000 invested. In 10 years, you've got 100 grand invested. In 20 years, you've got 387, and at the end of this 45-year period that we're looking at on here, you've got £5.3 million. It really doesn't take that much to become wealthy using index funds. Beyond that, if you then start doing some clever things with property, and you can download in the description some of my analyzers and some of the sheets that I've done to look at property and how you can build a portfolio over time, you can really exceed that because you're using leverage. But remember, with reward comes risk. It's not just reward and reward, it's risk and reward. And it's important to say that leverage, it can make you look very clever and it can also make you look very silly very quickly. So that's my take on it. If I had £1,000, my first place would be ISA, form a habit, get it into index funds, but let me know in the comments what your opinion is. My go-to place was obviously start a business. My other go-to place is invest in yourself, but I want to give some practical steps that you could do today. And the practical steps for me would be set up an ISA, get the money in the markets, and get a subscription going in so that every month you're buying more of those index funds and your portfolio is building month in, month out. I think that's the best way to get started. But guys, let me know in the comments. I'd massively appreciate it. I hope you've enjoyed this video. It brings me back to anybody can do this, right? Like anybody can become wealthy. It's just about believing in the end destination and getting started. Guys, thank you so much for watching. I will see you on the next one. Take care.